Welcome to the Piercefield Oliver podcast. I'm delighted to be joined by Lothar Mentel, Chief Investment Officer of Tatton Investment Management, and of course my colleague Matt Rowe, Certified Financial Planner. Now, today we're going to be looking at the year ahead and also reflecting on 2024. Now, we have a new government been in situ here in the UK for about just over 6 months now. And of course, we've got Trump back in the White House. So let's see what happens. And Lothar, do you want to give us, just start off with the year that's passed? How do we feel about that?
It came out better than expected, so it was a pleasant surprise. If we cast our thoughts back a year, the expectation was that really without quick and strong interest rate cuts from the central banks, we would have a hard landing. It wouldn't be a great year. I said, well, I'll be happy if we get single-digit returns into the portfolios. And at the end of the year, we had, well, even the most risk-averse portfolio, the defensive, produced 5% return, which is nicely above the 2.2% inflation hurdle. And the highest equity portfolio that we have produced over 18%. So it was quite strong, and it was quite strong because the global economy once again showed more resilience than anybody had expected. So demand kept up, earnings, corporate earnings therefore grew. And let's not forget, we really found this growth catalyst in artificial intelligence, AI. Everybody wants to have it. Everybody wants to buy it. And that really boosted the earnings of the US mega caps, which were really the story of last year. If you weren't invested there, at least with some, those big returns that I mentioned early on probably weren't going to make it into your portfolio.
Yeah. So a good year for those clients who have equities in their portfolios generally.
Yes, I mean bonds, at least for last year, outperformed inflation, which is the important bit for investors always to grow the purchasing power of their money, not go backwards. And on that score, it still worked. But the really exciting double-digit returns, yes, you had to have a good slug of global equity, preferably US equity in your portfolio, which also, let's face it, makes investors nervous because it seems to have certain parallels with 25 years ago when we had the dot-com bubble.
And the FTSE was a little bit more loved, wasn't it, last year?
A little bit more, but not as much as you might have wanted if you were still following the old paradigm of the UK has got everything that you need because our companies are very international, which is still true. But the UK has also turned into somewhat of a sector play because it's full of energy, resource, banking, some pharma, and therefore, when the whole world wants IT, then the UK is going to lag the global equity market.
Yeah, so most of the returns came from the US last year. You need to have exposure to the US.
And uncomfortably to the very top end, which a lot of investors felt and strategists and analysts, that was very highly valued. But fact of the matter is that's where the earnings have been coming from for the last 15 years. The only discernible earnings growth, if we really look at the charts, came from the US, and it came from US large caps. And therefore, whether we like it or not, you have to, adopt and adjust your portfolios accordingly. It's not to say that we've been overweight them, but we do understand that if there are consistent earnings growth results coming through from one sector, that will attract more investors, and just denying that won't help your portfolio returns. You just need to be careful going forward that you don't miss when it might go the other way. So very timely. Today we've got it looks like we're going to have a bit of a sell-off in the NASDAQ, which represents those shares because China seems to want to put together a little bit of a counterforce with its own AI, and there are all of a sudden doubts creeping in whether you really need as many very high-powered NVIDIA chips as ChatGPT and Copilot and all the other US AI tools are currently deploying and applying. I think the jury is out on that, but what it really tells you is that investors are nervous because all of their valuations at the moment are built on certain growth assumptions. And if the parameters of those growth assumptions are all of a sudden undermined or put into question, then we find out that actually they're not that certain about these things carrying on forever.
Yeah, yeah. Yeah, diversification is the key, isn't it, later? We'll come on to that, but it just shows you just how much markets are driven on sentiment. One announcement can shift the market, can't it? In a matter of hours. And of course, we've had, looking back last year, we had a change in the government in the UK, and the market seemed fairly okay about that, didn't they, really, to start with?
Yeah, we started with a really big positive sentiment, upfront credit almost for this government, but unfortunately, the government wasn't that great in managing the PR message towards the economy, towards the business sector, and to a certain extent also just generally the taxpayers in their desire to be absolutely honest and transparent. They overdid it a bit and portrayed everything as so negative
Yeah.
that everybody thought, oh, must be really negative. When actually we are, and at that point particularly, we're doing a lot better than our nearest neighbors in Europe, who are still a lot more under pressure from high energy prices and lack of or declining export markets in China.
Yeah, we need to be confident, don't we? And markets are driven on confidence, aren't they? It's about, us going out and going out for a meal and spending money. It's driven by the consumer, isn't it? And if you purport the doom and gloom that we've had so far, not to be political, but this government clearly has started with that doom and gloom message, then you do feel like that as a business owner. We've seen that. So let's hope that some of the positiveness that's coming out of the US at the minute rubs off on the UK.
We would hope that very much. There's certainly a lot of positivity in the US, which is a bit different in their perspective to the new old president. But maybe we've got a certain perception bias there as well, as we wrote in the Tatton Weekly last Friday. We need to be aware of that. And at the moment, yeah, Wall Street is very much giving him the benefit of the doubt and basically saying, oh, he'll do all the things that we think are really good, as in cutting taxes, reducing regulation and things like that. But he won't do the things that really would hurt us, like expelling 11 million of the workforce or putting huge tariffs in place, which would certainly drive inflation back up very quickly and be really very bad for the US economy.
Yeah.
I was just going to ask later, with obviously with all these promises that Trump did leading up to his election, how much power does he actually have? Because I think for a lot of people, the political system in the US is quite complicated in the fact you've got the House, the Senate, and then obviously the presidency. So can he get all these things that he wants to do put through, or how does it work?
Well, we need to probably establish that does he actually want to get all those things through exactly as he said he would? And we need to remember what worked in his first term will and already applies in the second term. You have to take the man serious, but don't take him literal. Mm-hmm. So not everything that he said, he's actually. So, for example, if he was going to cut the U.S. federal budget by $2 trillion, the U.S. would get the mother of all recessions straight away. It's just you can't cut out that much spending and expect nothing to happen. So no, he's not going to do that. He will drive to make the government more efficient. That's where you have to take him serious. He's very likely to expel those immigrants that have now got a criminal record or whatever else, but he's very unlikely to completely undermine the US workforce that, let's face it, has really driven their growth over the last couple of years. So, and then once you get to what can he actually do, he can do quite a lot more than other governments around the world because of, the powers that they have, but he can't do everything. And therefore, he can do more in foreign policy than in domestic policy, and that may be why outside the US people are looking perhaps more negatively at what might be in store for them than in the US itself.
Yeah. There's a lot of comparables with the UK and the US, isn't there? When you think about, he's wanting to streamline the government departments. We've got the same issue here, haven't we? Keeping inflation under control, the whole immigration issue, how that impacts on us as here as a country. There's a lot of things that we do have in common. It'd be interesting to see how the Trump, seemingly taking charge, how that has an effect and how quickly, and just for us really sort of to reflect and see.
Indeed, I think it is also at the moment in terms of the parallels very much how is he going to bank on that positive sentiment that has gone his way from Wall Street. Although it has to be said as well, initially we had the downdraft in December when the policy uncertainty led to higher yields, and higher bond yields are not great for the economy. We just need to think about mortgages, for example, and how that curtails your spending. And therefore, apparently at the moment, the thing that he most dislikes is the fact that he can't bully the bond markets. The bond markets will what the bond markets
Do
do,
what
and
they
he has
want to
to
do.
keep them.
Absolutely.
He has to keep capital markets entertained, and that's one of the bigger controls, if you like, for us investors, that we know that while he's very much always eyeing the opinion polls, his biggest and most important barometer are the stock markets. And therefore, he's unlikely to do things that are massively going to upset, even in the shorter term, the stock markets, because he sees that as a barometer of
That's
how
good
much
news for
he's
us, isn't it?
liked.
It's good news for investors.
Indeed, that should keep things a little bit under control.
Yeah. And what about currency? Because our pound is weak at the minute, isn't it? Because of how
Well,
we've seen with the international community. Is it comparably weak?
it weakened after it strengthened, let's put it that way. So, with a new government last year, it strengthened, and then it started to weaken, particularly against the euro. The fact that it weakened against the US was not so much a relative weakness of the UK, but a relative strength of the US. It's always you have to read these things in various directions. But at the moment, it is fairly stable. The bigger concern was really the hike in yields that we had in January, where in a way, January has already been the microcosm, if you like, of what the year will bring, which is inflation, and therefore yields and what yields might do to the economy and markets. And as much as the media here in the UK wrote about the hike in yields in the UK as a sign of fading trust in the UK government, we observe that same increase in yields, even larger, took place in the US and Europe.
Yeah.
Um, the UK has got the specific problem that some of our legacy pension funds are still full of very long maturity bonds, and therefore at some point, at some threshold, it accelerates faster, that selling pressure in the UK. But it's not necessarily anything to do with waning trust in the UK as a nation overall. And the evidence for that was that we had one of the most oversubscribed new issuances of gilts last week, with 14 times oversubscription. And I think, therefore, the demise of international investors' belief in the UK as a nation was probably a little bit premature.
Yeah, and they're getting a good yield, you see.
Indeed.
So that's
And
good. That's
yeah,
good. So we're still seen as good for our credit, but it doesn't help the cost of our borrowing, does it? That's the problem.
that is the problem indeed.
Yeah.
Yes.
Yeah. So oil prices. Now Trump's got this big drive to get the price of oil down, hasn't he? And I know he's called on the OPEC communities to bring the price of oil down, and I think he thinks this might help with the war, Ukraine, Russia, etc. What's your view on that, and how might that affect the financial markets?
So firstly, if he is really somehow able to end the Russia's war on Ukraine, then yes, that would have a very positive impact, particularly on European gas prices, which would bestow a very nice peace dividend on Europe. With regards to his drive to increase the oil production, the drill baby drill
Yeah.
thing, the big oil multis have already fed back to him that actually lower oil prices are the least in a negative incentive to bring more production on, because if your margins are lower, why would you want to pump even more to lower your margins even further?
Yeah.
So either he hasn't entirely understood how market economics work, or he's just, one message is for one side and the other message
Yeah.
is for the other side. But I mean, generally, oil prices are likely to come down because there is a general overproduction perspective or scenario in oil markets at the moment. Therefore, we'd be very surprised if they didn't gradually come down. Whether they come down as much as he would like it, that's a different question.
Yeah. And Matt and I were talking about the markets and how they react to geopolitical situations now, which is not as much as they used to, actually, because we're quite used to bad news. And I think in a way that's sad, but the markets seem to survive, don't they? Because, if there's a terror threat or there's an attack, there used to be quite a sell-off, but now not. So it's as if we've kind of sadly got used to it.
To some extent, but I think particularly for 2024, it was more a question of, is it getting worse or just staying the same? And that's very much where we saw last autumn. Yes, the oil price did react, and there was a bit of a stress in the markets when there were missiles flying back and forth between Israel and Iran, and there was this prospect of a serious escalation of hostilities in the Middle East. When it became clear that it was just very similar to what we had before, all things came back to what it was. I think at the moment it's more, as I said, the opposite. If Trump can actually really somehow quiet down the Middle East and the Russia geopolitical stress, then that actually would reduce geopolitical stress, which is currently fully priced into the markets, and that would improve matters. I'm not sure how much it would be incrementally felt in the US. As I said, it would be a real boost for Europe and potentially also the UK.
Yeah, let's hope that he can calm that. That would be a real positive for this year, wouldn't it? For lots of reasons as well.
Yeah.
Yep.
For the world.
Speaking on the sort of geopolitical issues, then these tariffs that he's sort of been hammering the drum about for a long time. Obviously, we've seen a little bit of mixed messaging, haven't we? And I saw it in the Tatton Weekly last week about the fact that originally it was going to be 60%. Yeah, and then it dropped, and then now he's. Do you want to just talk us through that?
Yes, so I think the interpretation in the US is that, it's all art of the deal, or you could also call it bullying, in order to get what he wants, which is a more balanced trade relationship with China. And China does want it itself, wants to have a more balanced trade relationship where they've got more domestic demand and less reliance on exports. Generally, the issue and the challenge that he has is that if he was really going to follow through with significant tariffs, he might say it's all going to be paid by the Chinese, but the fact of the matter is it's being paid at the ports in the US, and therefore it is going to be paid by US consumers. And that was the experience with the first round of tariffs that they introduced back 8 years ago. So if he does not really, if he follows through to a large extent, it is going to increase prices, and that could trigger another bout of inflation. And it's about the last thing that he wants, because he understands very well that he won this election on the back also of people just being majorly upset about the loss of purchasing power that inflation surge bestowed on them, gave them over the last couple of years. So it's the last thing that he wants.
And how have the Chinese sort of markets reacted?
The Chinese market's very much priced in that risk, it seemed. I mean, they were very much in the doldrums anyway because of their property crisis and having managed again, the sentiment side of things very, very poorly from coming out of the pandemic, where their citizens really lost all their appetite for spending a lot of money. Interestingly, the Chinese market last year was another one of those big surprise factors in that it was really, really lagging until they came out with an announcement that they understood and would be doing something to stimulate the Chinese economy back into form. And we saw a huge surge of the Chinese market, which all of a sudden surpassed the US market briefly until it came back somewhat when they didn't quite follow up on all their seeming promises. It is still starting to get better because it is one of the cheapest markets by valuations worldwide at the moment, and the Chinese economy isn't quite dead. It might be a bit different, a bit less reliable on generally in the rule of law and all these things, but we're quite glad to have maintained at least our neutral position in the Chinese markets. Otherwise, investors would have lost out.
And what's your view on interest rates here in the UK, Lothar? Because, of course, with the NIC increases for employers, we're seeing there's potential pressure on prices, and that could be inflationary. Businesses are really finding it difficult. I know quite a few businesses are finding it hard at the minute with the new employment law, NIC, all of the things coming their way. Do you think that in the UK, we will see a reduction in interest rates, even so?
That's very certain that we will see a reduction in interest rates. The question is more by how much.
Mm-hmm.
I think a lot of people expected that interest rates would fall down to 3%, maybe even less than 3%. At the moment, we're at 4.75. At the moment, the implied market expectation, we can read that off the forward rates, is they won't fall beyond 4%. So that's not really a huge amount. It would be 25 basis points interest rate cuts. It's not massive. It will be welcomed, but we're more back in the old normal environment that we are still very much aware of in our generation, but the younger generation probably think they will be able to get mortgages again at 2 or 3%, and I'm afraid
Not coming, is it? No, it's not going to happen. No time soon. What about cryptocurrency? Bitcoin and Trump with his
Well, yeah, he's launched his own coin, hasn't he? No, I was going to ask more generally because he's championing the US, isn't he, to become a crypto capital and talking about this strategic reserve for the Federal Reserve and all this business.
Which has been a real tailwind for all of crypto because, you know, they all of a sudden see themselves being a little bit in the sunshine.
Mm.
Well, I think for investors, we have to say it is a asset that we should not ignore, but it's not an investment asset. It's a trading asset, like there are other trading assets like commodities, there's gold. There are a lot of things that you know are speculative. You could make a speculative gain on it, but it's not a consistent asset investment. And you know, I oftentimes call cryptocurrency gold for geeks because it is very similarly to gold. It's not quite clear what is underpinning it. There are no earnings, there's no yield, there's not even a government or any tax authority like with currencies that's underpinning it. So it's purely speculative and therefore very, very well, it's unforecastable.
And no regulation.
And very, very little regulation. And
Yeah.
therefore, it is not something that we would entertain in our portfolios, which isn't to say that some of the technologies that are being used around it are very interesting and are already in some of the fund portfolios of the underlying funds that we hold.
Blockchain. Yeah.
Exactly. So those things, let's not ignore it altogether, but let's also say here and now, our investment portfolios are about consistent investment management. They're not about speculative assets and speculation in things that go hugely up and hugely down without us having any idea why that might be.
That's comforting to hear. So, environment, social governance, ethical funds, the whole sustainability sector, with Trump pulling out of the Paris Accord, seemingly anti sort of climate drill, baby drill. So how do you feel that may affect those sort of holdings that are in that area particularly?
I'm not particularly worried and concerned about that because ethical, and particularly our ethical portfolios, are not all about energy. And anyway, that turnaround already happened with Russia's invasion of Ukraine, that the world came to realize, well, we probably still need the stuff for a while. There's a transition. But ethical investment is all about the things that are going to shape our future. And that's not just around the environment, that's around many other things. And they're not going to be stopped by 4 years of Trump presidency and the US in itself. There is so much drive in actually making our planet a better one on the governance, on the ethical side, but also on the energy side. And the amount that the Chinese, for example, are investing to detoxify their whole economy is quite impressive. So it's not all dependent on the US president.
And we need those companies, don't we, with their innovation and their focus, and they're the growth companies, and those are some of the companies perhaps we'll see in the portfolios for that longer term investment.
Exactly.
So have you got any sort of outlook later for the next year? I know it's looking into a crystal ball a little bit, but
it sounds very similar to my outlook last year, which is I'd be very happy with healthy single-digit returns. Let's not get carried away. After 2 years of double-digit returns, it's very prudent not to expect that happens again. At the same time, I'm also not in the camp to say, oh, after 2 good years, there got to be a bad year, because if we just look back 3 years, 2022 was actually pretty poor. And if we put the 3 years together, we're just back to the long-term normal averages that you would expect from a balanced, a defensive, or a equity portfolio. So it doesn't feel we're particularly overpriced. We're going into this year with a pretty healthy economic momentum, particularly in the US. There's not too much really dark clouds on the horizon. But one thing is for sure, political or policy uncertainty at the moment, and that moment in the morning will continue to cause volatility in the markets, just as we had last year. And we're just experiencing it today again with these news around AI and perhaps a rival AI mechanism or technology from China. Markets are somewhat nervous. So even though we will probably, hopefully, end this year on a positive return note, there will be plenty to talk about, write about, and perhaps worry about in the meantime in terms of up and down.
Yeah, it's going to be an interesting one, isn't it? And just bringing it back to planning, because that's what we do, financial planning. So that brings the confidence. So as long as you stick to the mandate, you've got your plan, you know what you're aiming for, you know how much you need, and provided that you focus on that, then stick with it. It comes good, regardless of all of the noise that happens in the world and the markets. It's not to worry too much about that. Stick with it.
Exactly. The world is changing, but the very long-term trends and observations continue to be there and persist, and therefore don't get derailed by the short-term noise.
Okay. Thank you, Lothar. That was really interesting. Obviously, there's always lots to talk about. I'm sure we could go into these topics in a lot more in depth, but that was brilliant. So it's onwards and upwards.
Thank you very much.
We'll see you soon, and thank you once again, Lothar.
thanks.
Thank you. Take care. Bye.
Bye.